5-star investing starts with NabTrade, proud sponsor of The Call. Find out more at nabtrade.com.au/The Call.
It's a Friday. Great to be here with you for The Call. You know the drill. 10 stocks picked by you, 2 expert guests, 1 hour, and me, your host. I'm Nadine Blayney. If you are watching us on Twitter or YouTube, a special welcome to you too as well. Great to have you along. This is the program that we do Monday to Friday between 12 and 1 p.m., but you can also catch up via podcast or on our website. It is the dynamic duo back in the house, virtually, of course, on this Friday. Claud Walker from A Rich Life, Rudi Filapek-Vandyck from FNArena. Rudi, I'm just judging your hair. Yep, you're still in lockdown. How are you traveling?
Well, I'm actually quite used to being in lockdown. I mean, as you can see, I'm not seeing too many people outside of my house, but for the rest, as long as we can do this, I'm still in contact with the outside world.
That's good. Now, Claude, I'm not going to waste too much time off the top here because I am going to put you both under pressure. So this is a bit of a tease for our audience. I'd like a buy that we don't talk about all the time with both of you at the end of this program. Please, please. So I'll put that out there. For now, though, I would like to get across the stock of the day. And I couldn't look past Iress today because it's a hard one to miss, at least judging by the news this morning and the share price reaction. So takeover talks ending between it and EQT after the two failed to come to an agreement. It's believed on a transaction price which could have seen EQT buy out Iress. Now the third attempt was priced at $15.91 a share, valuing Iress at some $3.2 billion, and it came after the company rejected the previous 2 bids from EQT, saying they didn't provide compelling value to shareholders. So the talks have failed. Iress remaining committed to doubling its net profit after tax by 2025, reaffirming its FY21 forecast for segment profit of between $164 and $168 million. Let's get a view from my guests on what's come to the fore today with Iress. Claud Walker, it's an interesting one, isn't it? Because EQT coming out and saying we've not come across any red flags during our due diligence, but we're not able to sufficiently confirm our investment hypothesis. That's done and dusted, isn't it?
Well, yeah, it is. But there is one bit of new information that we got today that we can say with confidence, which is that Iress looks better from the outside than it does from the inside. So I think that's a negative in terms of the true quality of the business, as well as obviously for the share price. We've seen a bit of a drop today as people who were hoping for the takeover money have failed from the stock.
Where to from here then, Claude?
Well, for me, now, of course, Rudi is much more knowledgeable about these big, old father-in-law companies than I am. But for me, this is a company that is sort of highly valued because of its high resilience and high revenue, consistency of revenue growth. However, from memory, what that hasn't really translated to much impressive profit before tax growth over the years. So I actually think this is a generally overrated company. And part of the reason it's overrated is because it is a reliable dividend payer in, I think, the 3.5% range. So I could definitely imagine, especially people that really love franking credits, I could definitely imagine them, buying, holding this kind of stuff. And I guess that's why, that makes sense for those people. But overall, I actually think it's an overrated company generally.
Rudi, your thoughts on Iress, because just reading through some of the broker notes, Yeah, it appears as if some of the brokers at least don't feel confident that there will be another offer made for the company. But is Iress fine to go it alone and keep doing what it's doing? It's just reaffirmed its guidance as well.
Well, Nadine, let me answer that question in the complete opposite way as you've just heard from Claude. And this is obviously why live television can sometimes be so exciting for the viewers. I own Iress. We've spoken about this in the past. Contrary to what Claude said, I don't think the company is overvalued at all. It's actually undervalued. The reason why Iress hasn't performed share price-wise over the past 5 years is because they felt the need, and probably rightfully so, that they had to crank up their investments. And they're pretty much investing every year now, double the amount that they were investing 6 years ago. And that, of course, has meant that their profit margin has consistently been under pressure over the past 5 years. And that means that even though their revenue were growing every year, their profits were not, and their dividends only slightly so. So if you now hark back to management's forecast, but they're very confident they're going to double their profits over the next few years, then that is probably a call on the margin. And admittedly, investors are rightfully so a little bit skeptical, because they have flagged a couple of times in the past that they believe that their margin would no longer come under pressure. And yet it did in the subsequent year again. But of course, margins don't drop eternally, you would expect. So on the expectation that margin starts trending upwards again, that forecast might actually prove quite prescient. And if that forecast is prescient and accurate, then then I don't need to do a design here or a special design. The share price will be a lot higher in 5 years' time, or in 4 years' time. It's 21, by 25, it's 4 years. Share price will be a lot higher if they do double their profits over that period. I actually can give you a scoop as well, because as I said, I owned the shares, then I get a couple of takeovers, so the share price runs up a whole lot. And then of course it's not binding, and there is no certainty that this will lead to a positive outcome as we've seen this morning, which put me something in a quandary, because what do you do? I have decided out of risk management, I sold half of my shares, upon which I have obviously made a very good return in a relatively short time span. And then what do I do with the other half? I decided recently that I would be happy to own the shares if the transaction did not go through. This morning we have a minus 10%, 11% that goes off the share price. And this is probably the first time on live television that I am not unhappy that share price falls. I might even reconsider that I reinstate the previous weighting I had to this stock. I'll think about it over the weekend. Contrary to what Claude says as well, the buyer of Iress, potential buyer of Iress, obviously was considering spending a lot of money, and somehow they believe that whole image about our customers are relatively sticky, they couldn't make that fit in their own thesis. I'm not so, well, that there is obviously gradations. Usually you get the opposite. Usually the share market doesn't appreciate the stock and then the buyer does. In this case, we get the other way around. They could not get Iress at a cheap valuation, of course. I'm still sticking with management here for the reasons I've just outlined. I'm a happy shareholder. I'll happily cash in those dividends, and I expect them to do well over the next 3 years.
Oh, you've left me in a bit of a quandary, right? So do I call that a buy today, Rudi, for Iress or not?
Oh yes, I would. If you don't own it,
if you're not owning it yet, if you don't own it, today would be a good day to buy Iress.
I would consider buying it. It pays a good dividend. And management is confident that they will double their profits over the next 3 to 4 years. That is something to look forward to.
Claude, were you going to add something there? I will give you an opportunity that you don't have to take it.
I have a feeling that Rudi will do better off with some of his other favorites from Iress. Like, I agree, maybe decent dividend stock, but I just think that if he's, I know Rudi's like a long-term style investor, usually going for the long term, and I just think that this company is probably no longer in its prime in terms of it's no longer organically winning more business in the kind of way that maybe it did in the past. And I think that probably to double that profit, they're going to need to buy a lot of, I don't know what they're going to do, but we'll see.
Well, look, we're going to agree to disagree on this one, you guys. And I will put some of those questions to management on Monday. We will speak with Iress CEO just past 11 a.m. Eastern. So, yeah, looking to go right to the source. He's obviously a bit tied up today. All right, let's get right to it. Our first stock of the day picked by you. Tilly wants a view on Ardent Leisure Group. ALG is the ticker code. Rudi, over to you.
I don't think we have to make this too long. Why? I mean, that's my... I mean, surely you don't have to be an investment expert to see that this is... I mean, can we even call it an investment-grade company? I don't know. Listen, to put it very briefly, 10 years ago, this was supposedly a reliable dividend-paying stock in the share market, relished by many because at times it would pay 13% forward-looking in dividends, and of course people loved it. Right? Today, the share price is a lot lower. Annual sales have been in decline for every single year for at least half a dozen years. The profits are under pressure. The margins are under pressure. Now, admittedly, they had a few accidents along the way, and we don't have to go into the details, but they also have stopped paying a dividend. Yes, there's always that turnaround potential, but I would say let's look elsewhere. It's not worth it. You don't want to be sitting on a stock like this if it doesn't perform. I mean, we just spoke about Iress, who predicts they're going to double their profits over the next few years. This one is not going to do anything near that, and that includes the next 6 months.
Claude, are we keeping this one short and sweet for Tilly?
Yeah, I guess we may as well. Look, I think probably a lot of I agree with what Rudi said, so I probably won't repeat that. But I'll just say, I reckon that perhaps a bit of the share price recovery that we have seen in this stock is actually short covering. Now, actually, back when the pandemic hit, this was one that I shorted. Many people shorted it. It was obviously going to be in trouble. And I think, in the last year, we've seen the graph of the short positions is almost the exact opposite of that share price graph there. And at this point, there are not many shorts still in the market. I have a feeling that we might see that the gain of the recovery is now in the past. So I definitely, agree with Rudi.
Okay. There we go. Ardent Leisure for you, Tilly, and not the reopening stock that some perhaps would think it is. Let's go to the next company on our list for AJ. Hey, AJ, thanks for writing in. Phineas Corporation, FCL. And he wanted your opinions specifically, guys, saying, I'm wondering if the company's turned its corner in its most recent update. Now, is it a good time to get on board with a medium or long-term view in mind? Or is there limited growth in the product niche that it provides once all insurers adopt its software? Claude, you first, please.
Oh, well, I think that the questioner itself has done a really great job. I enjoyed that. And I'm sure Rudi has a slightly different view of it than I do. The question that I think they're getting at, as is often the case with these kind of software plays, is whether it's going to be a hard yakka to grow kind of story, or if it's going to be an easy one, high demand for the product. If you have high demand for a software product, you can transform from loss-making to very, very profitable. And you can also have a high confidence that you're going to be able to do that. So that's why a lot of these software companies tend to trade on high multiples. Phineas probably hasn't done as well as I thought it would in the past. I'm a previous shareholder of this stock. And the reason for mine is that at the moment, we're yet to see that sort of organic growth take off, and it's had to dilute itself, both for losing money and for growth initiatives. But for acquisitions, they've had to, basically issue more shares, and as a result of that, you don't tend to get that kind of explosive kind of gains you get from a software company that's run, or any tech company really, like a medical company, anything that's growing quite quickly but doesn't have to dilute generally is a better bet than Phineas. So for me, I've actually decided, I sold out of my Phineas shares, and I actually decided, even though I still think it's a good company and I think it will do well, it's just too hard for me to model actually detect and be certain that actually it does have good enough products for them to just grow naturally out of demand. And in fact, some of the research I've had done in the past suggests that perhaps some of the code base that this company's built its business on is kind of old, and that sort of gets into a concept called tech debt, which is probably one of the things that I deep dive in more than most people, which is partly due to the fact that I've worked developing algorithms and worked in code myself, and I've worked enough in a software company to see that how like having old technology written in old code bases that don't interact as easily does cause trouble and cost lots of money to fix and make it harder to grow and improve. And I have a feeling that may be some issues here with Phineas, hence why I'm on the sidelines. But having said that, even what I said, like heaps of good companies have tech debt, it's fine. It's not a killer of the thesis. So for me, it's kind of, I'm a bit ambivalent on it, basically.
So that would be a hold if you have it?
Yeah. Well, yeah, I guess a hold. It depends what you how you interpret that. Like, if I definitely wouldn't sell because of me, put it that way. But at the same time, I'm not buying even though I don't have it.
Good. Now, Rudi, does this company Phineas have a lot of cross-selling and upselling that it can do with its existing companies, or again, does it need to keep acquiring to grow?
No, it doesn't. I think that the formulation of the question was a little bit too much focused on the share price since listing. This company is not listed for a very long time, and it had the unfortunate coincidence that COVID and lockdowns broke out, and that put the whole business model on pause for quite a while. One of the major impediments to go full force into this stock was the fact that it's not profitable and it needs capital to grow. Now, it recently raised capital, and now that problem has been solved. We are also coming out of lockdowns and COVID, and I think people really don't understand where the growth of this company comes from. What we are facing here is an international insurance sector that is under pressure because of climate change and other problems, and they desperately need to basically become more efficient. Now, this company has one of the solutions to become more efficient. So the logic here is that as long as they do their marketing correct, and they're not the only one in that sector, by the way, there are a few American companies that are competitors, but as long as they keep on winning new accounts alongside the Americans winning their accounts, then this company should become worth a lot more into the future. It's about acquisition of new customers more than acquisition of other companies. And if you believe that management can do just that, and they just raised the capital to do it, they should be profitable in 18 months from now, approximately. And that means this is similar to Iress. If you believe that management can execute on that, then this is actually a buy today.
Well, you answered my question, so it is a buy today. I was going to get the chart back up on screen again, but there you go. You know the routine around here, Rudi. It's only taken me, I'm kidding. Okay, let's get on to the next company, NZME. NZM is the ticker code. This one is for Sam. Look, it's media. It's a tough business to be in. Publishing, radio, digital. Would this be the type of company that you would think, Rudi, has enough growth, has enough capital growth coming its way to make you interested?
What do you think, Nadine? Well, listen, for people who are not familiar, this you could sort of say this is the Fairfax of New Zealand, sort of, approximately.
Small market that.
And of course, Fairfax now is part of Nine Entertainment, so they no longer exist on the soulless basis either. I mean, I can't. No, there's too many shifting plates there, and you always have to. I mean, every investor has a limited budget, one would assume. So you have to be a little bit careful where you put your money, also in terms of risk, and whether you want simply short-term rewards or a decent, sustainable return over a longer period. For me, this type of company is too small, too many question marks, too many challenges. And yes, of course, everyone comes back from a beaten down, very low level. Everyone has a recovery after a bad period, but that doesn't mean it's a sustainable, great investment. And I would, to be honest, I actually had forgotten it was actually listed on the ASX. But it doesn't mean anything. I would not consider it, to be honest.
Okay. And I'm Switzerland on these issues. Rudi, you can't ask me what I think. Claude, what do you think? Because I can ask you. What do you think about NZME?
Well, I do think a lot of the similar things as Rudi. So if I kind of build on that, I think there's kind of a theme in some of the stocks we have today, which is more so than usual. Some of them are sort of what I'd call pro-cyclical stocks. And like media that's based on advertising, that could be, O Media, the billboards, or NZ Media, the old school New Zealand media company. Well, that is a pro-cyclical kind of business. And so even though it may look kind of attractive as a dividend stock right now, I think it's a 6.5% yield based on like the last half anyway. And it's, looks like it's cheap, P under 10, right? So I can see why dividend investors, value investors, could be attracted to this stock. Quite frank. However, it's worth remembering that these kind of pro-cyclical businesses won't be there for you when you need them, right? So generally speaking, the time you might want that dividend or want the cash the most because you have a good value investment would be during some kind of sell-off like we saw in March 2020. But we just saw that 5-year graph, and you can see how that got hit super hard right down during that period, and now it's kind of just bounced back to where it was before if we look at that longer-term chart. The question then becomes, what are the longer-term influences? What are the changes in the world around us that are influencing this business, and are they making it easier or harder for them to make profits? And I would say we're still in the harder phase of it. Yes, obviously traditional media has taken an absolute whack over a long time, and it's restructured and it's consolidated. Having said that, we're also seeing an environment through the internet, just as someone's maybe listening right now on Twitter, that did not exist 5 years ago, and I am very confident that other players are going to be very fast on their toes in that kind of new emerging landscape, whereas some incumbents may have trouble keeping up. And you never know who the new guy is that's going to start taking some of your share, but there are so many now that are enabled by the internet. Yeah. So I think it's a difficult headwind for them, and as a result, it wouldn't be a stock that would interest me to hold or buy or really have anything to do with.
That's an avoid. So Sam, there you go. That's your answer. Let's move on, guys, to the next one on our list from Dom, Appen. He's given us a bit of context, which I like getting sometimes, because he's saying, I purchased Appen early 2021 for $15.27. Company's basically drifted lower for there. We know that it's been in a downgrade cycle. So what does the panel think? And I suppose that gets to the heart of it, because it's not just about what we buy. It's about what we sell. And sometimes you do need to sell. So should Dom be selling Appen in your view, Claude?
Well, I don't want to I don't know Dom's exact situation, so I wouldn't want to give any kind of personal advice to him. I guess more generally about Appen, there was an article that I wrote for people, I was hoping to avoid people in Dom's situation, called The Truth About the Appen Business Model. And if you read that article, you'll say, and this is I think the real key point, is that around the time when Dom said he bought it, the share price had come a long way down from maybe $40 to, when did he say, I beg your pardon, it was 15 or whatever. So you can sort of see somewhere in that descent, he jumped on board. And I guess it's one of those things where there was a little more bad news coming out about the stock or about the business, and its failure to grow. And I guess there was a view in the value investors guy as it comes down 70% or whatever, and the value investors almost immediately need to stroke their beard and be like, oh, this is too far, the market's overreacted, they're hysterical, and I'm calm and wise. But the thing is, these value investors haven't been following this business. They're not across the story in the same way like the growth investors were, who got on board, who've been following it since 2015. And I will tell you what drove that growth was the historical growth was a huge amount of business from Google, Facebook, Microsoft and those kind of massive tech companies. When this story started, I think it was just Microsoft when it got listed, and it just exploded because they're basically providing that data that these guys needed. However, what people have completely, in my view, discounted and forgotten about is that after a certain period of time, the need for data labeling, which kicks off your AI stuff, potentially goes down, because even though the generation of AI algorithms continues to increase, the data sets can get reused to train different algorithms for different sources. And there was so many millions being spent on Appen having people label data manually. Of course, the capitalist ecosystem is going to have other people being like, hey, can we automate that somehow and make it cheaper? So inform yourself about something like Snorkel, a Stanford University initiative that set out to explore the radical idea you could bring mathematical systems structure to the manual process of data creation, right? There are people that are literally going out and trying to automate this business. And I suspect that is why you're seeing a flattening off of demand. Haven't even got onto some of the other technologies of how they can sort of reuse that interesting space. But I think that there's a narrative being missed. And I think it was actually Macquarie Bank that was the first people that sort of come out and say, I think there's a demand problem here. And I believe that's correct.
Yeah. All right. Rudi, do you have anything to add to that for Dom?
The shares before Don bought them, but I used the word owned, so that probably gives an indication. I think by looking at the share price, and that's basically what Claude is saying as well, by only looking at the share price, you're often making the mistake thinking, oh, it has fallen so far, it must be a buy here. Macquarie did bring out that report. I think from memory, the share price was around $24, $26 maybe, around that level. And what Macquarie said was that the dynamics in the industry were rapidly changing, in that Appen had become too big for the industry, had too much pricing power. And what the likes of Google and Microsoft were doing is they were now allocating smaller types of contracts and therefore creating pricing pressure, because other companies would turn up and say, well, we can do this small part of your contract as well. And that completely changed the dynamics internally for Appen, of course. All of a sudden, if you know a little bit about how mathematics works, imagine if you multiply 5 by 10, you get to 50. But if you multiply it by 7, you only get to 35. And that's a big difference. Mm-hmm. And that type of mathematics all of a sudden start then working for an Appen, which means that if you halve the share price, it's still not cheap. And to basically going to the core question that has been asked, if I still owned Appen shares, and I haven't looked at buying it for the reasons I just explained, I would probably not sell here, because you risk that you are throwing it away near the bottom of its valuation. Although I must say it's not exceptionally cheap here, it simply came down to more reasonable valuation multiples, because the business is changing, the industry is changing. So whoever owns the shares here should be mindful of the fact that the risks have not disappeared. There is still risk with this business, and they obviously are still under pressure. But the valuation at the very least has come down to a more reasonable level. So if you weigh up one against the other, I think Appen is probably a hold here.
Got it. Thank you. Dom, that is for you. And Claude, you've reminded me, as I do every week, to just say this is information only. It's not specific to your certain circumstances. So don't take this as financial advice. You still need to do your own research or get financial advice. Let's move on from that and get to the next company coming from Sam, Pure Profile. PPL is a ticker code, saying interested to hear what the experts think about that one. Data and insights business. He thinks the annual results looked pretty good, with revenue, EBITDA, and net profit all growing strongly. The company targeting continued global expansion. Look, I'm not really familiar with this company, so I'm presuming you guys did your homework. Claude, what have you found?
So actually, I was already familiar with this company. This is, unfortunately for my sins, exactly the kind of space that I follow. These little companies that sort of have a decent business, but you never really know when they're going to get good. Pure Profile has now, like, this is a history, and I'm sure that there's like some fans, the people that are probably actually looking up Pure Profile to hear about it. There's going to be some fans there that will have jumped on, and they'll have jumped on more recently as part of the turnaround story. But I do still think it's important to understand that history a little bit, because it is what feeds into existing skepticism today. So this listed a while ago, and it's gone down like maybe 90% from its listing price or from its highs anyway. And basically, it was in a situation where what it does is its main business now, as was then, is basically doing data insights work for companies. So it might go to a large company who wants to have a new product or a product feature, and that larger company wants to find out whether either its existing customers or a certain demographic would like that feature, for example. And then through a number of other partnerships, it has Flybys, Raise, and then its own database. Pure Profile sort of basically goes out and pays people to answer surveys if they fit the certain demographic. So it's actually a little bit similar to Appen in some ways, but its gross margins aren't that good because it's getting paid for the insights, but it needs to go and pay other people to get the data. And as a result of that, for many years, it was basically just like a negative margin company in my view. And it bought another business, and that was like in digital advertising trading or something like that, which also lost money. It was money losing in the hole. Now there's a turnaround thesis. So I slightly disagree with the questioner in terms of the fact that I'm not sure how I'm not sure how resilient this is as a long-term profitable business, just because its history of losing money is there. I'm not 100% fully in believing that actually, oh my God, the turnaround's here. But I do have to say that there is absolutely a viable turnaround thesis going, because they do have much improved results. Their most recent quarterly result disclosed, I think, a $1 million EBITDA for the quarter. And then they did a presentation, which I don't really like that they did this, but they did a presentation recently, and in presentation, in that they sort of disclosed that they've got very strong revenue growth so far. So obviously we don't know exactly, there could be different margins or whatever, but basically there's a good thesis to be made here that it has actually turned around. Now it's going to be growing its profits quite strongly, and then you've got your value thesis there. And I don't think this is a great quality tech business, but it does have a small amount of software as a service revenue, where it basically sells access to a platform that allows people to get their insights. So I could see the narrative switching there as well. So look, it's an interesting thesis. I'm still skeptical at the moment, but it's on my watch list. I have to say it's a good idea. In my view, it's probably I'm happy to put forward a more positive bull case, because I'm pretty sure Rudi won't like it. But I do have to say it's interesting. I won't say buy myself because I'm not quite there in terms of confidence level, but very interesting idea.
So it's on Claude's watch list. Rudi, I have a feeling that your computer's just going to say no, it's too small. There's other places to put your money, something along those lines?
Oh, I can make it even worse. I have some insights in part of that business that does the surveys, and I can guarantee you it's low quality. That's I can use other words, but let's just stick with rubbish. All right. I'm a firm believer that if you look back at the history of companies, it tells you a lot. And I like to throw in the usual quote from Warren Buffett: most turnaround stories don't really turn around. And yes, of course, share price is very cheap, and it will have a little bit of a rally at some point because it looks really, really cheap. But here's the proposition, and this is by no means investment advice, but I'm just staying within the framework of today's broadcast. I think the common mistake made by investors is only looking at the share price and then thinking it was so much higher in the past, now it's so low, it must be representing value. I always am a big advocate of looking at the companies behind the share price. And in today's broadcast, we had one company at the very beginning, Iress, which promises investors they're going to double, that's 100%, double their profits over the next 4 years. And then you get Pure Profile, right? If you look at the past data since it's been listed, there is a very good reason why the share price is where it is. The financial data are absolutely awful. Avoid.
Sounds like at all costs. All right, guys, we are at the halfway mark. Hard to believe, flying by this Friday. So let me just run you through it. Stock of the day, Iress. It is a buy from Rudi. He says it is looking good. He's backing management. Claude says that he thinks it's just an overvalued business. It looks better from the outside, apparently, than the inside. So he's avoiding that one. Ardent Leisure, short, sharp. It's a no from both of my guests. In fact, Rudi says, why would you need to own Ardent Leisure? Phineas is a buy from Rudi as well. He's in a generous mood today. He sees COVID as being unfortunate timing for the company, but he does believe it will be worth more at a later date. Claude doesn't really agree. He's calling it a hold. He says right now it's just a bit too difficult, too hard basket for him right now. He was, though, a previous shareholder, so he knows the business. All right, NZME, fair weather friends is what Claude says. These are cyclical businesses, and when you need them and need the dividends, often they won't be there for you. And Rudi just says, be picky where you put your money. That's a no from him. Appen is a hold for Rudi. So you just heard him talk about it. I don't need to reframe it. It's an avoid, though, for Claude. And he just sees that structural shift accelerating. Pure Profile, it's on Claude's watch list. Not so for Rudi. In fact, Rudi probably wouldn't touch it with a 10-foot pole. Let's get across the fantasy portfolio that we've got going here at ausbiz. And this is thanks to our partner at NabTrade. All the companies that get a 2 thumbs up or a buy from both of our guests go into the portfolio. Nothing's in there today. But here's how we've been performing. Not bad over the past week. So that's actually outperforming the market over the past week. Up by 1.5% over the past month. Full year to date, up by close to 5%. Since the inception, so we've been tracking this fund since July 1st, 2020, up around 42%. And the guys on your screens right now have had a hand in that. Australian Vintage has been added recently, Adairs, Cluey, PWR Holdings, and Resimac, but we've removed Medical Developments, Rio Tinto, which of course we've got, really iron ore being hit hard today. We've got UBS revising downward its forecast for iron ore, as well as Fortescue. It already had a sell on Rio Tinto. Raise and Energy One have been taken out of the portfolio, which you can check out by going to ausbiz.co/portfolio. We need to crack on with it, guys. We've got less than 20 minutes left in the program. So let's get to Aventus. This one's coming from Lyle. And I think it's interesting that he says maybe one for Claude. So let's talk to you. It's in real estate, large format retail stores. Many of you would have been to them. They've got a lot of homeware companies, I think you can call them, and about 20 centers in the portfolio. What do you think, Claude?
Well, I have to say I was a little bit surprised to be called out on this one myself. It was a bit of a surprise, but I guess maybe the viewer wants the sort of skeptical view, I guess. So I had a look at this. I guess big box or bigger retailers. It has a good client base. It looks like basically reasonably healthy to me as an actual, property trust itself. So I wouldn't. I'm not really against it or anything, but obviously I think the dividend yield's about 5%, a little bit more. And so I guess, again, it's just like a dividend stock. It seems pretty decent dividend stock to me, but part of my attitude is I barely ever buy anything for a dividend, unless it's a really high dividend, I'm basically trying to wait for a re-rate. I think this is about right. Again, it's that theme of a cyclical business. If we have a big recession and stuff, this is probably going to go down. If the economy's booming and stuff, probably keeps on increasing distributions. That'll put a bit of upward pressure on the share price. Now, I don't know. It's obviously these kind of stocks, everything benefits from lower interest rates and stuff. It's just very cyclical there. I don't love that myself about it. And then the other thing is, if you look at the history of their distribution growth, again, it's not like a real solid up and to the right stuff. So if I was really going to be a dividend investor, I'd be looking for companies that are so resilient that they always increase their dividend, increase or flat. And you can find such companies. So for me, lacks any real attraction, although I understand some people love these, investing for income and stuff like that. And that might be a different kettle of fish. Interested to see if I know Rudi does a little bit of dividend investing. Maybe he likes it. But for me, I guess a hold at best, if that's what you're into. Otherwise, I just see no attraction to own it, really.
Rudi, what do you think?
Don't ask a tech analyst to comment on dividend stocks. I own Aventus. I'm a happy holder. I actually think it's one of the more resilient dividend payers in the share market, and that's a hint to investors as well. If you are looking for dividends, don't just look at the yield that's on offer. Look at how safe and secure those dividends are. I think Aventus has proven in 2020 that even with lockdowns and a very sharp recession, that its type of business is much more resilient than many of its peers. Think of Center Corp, Asia Pacific, etc., etc., etc. It is that large format that keeps on opening its business and keeps on paying the rent for these guys. Of course, you should see it for what it is. It's a relatively steady growing dividend payer. It's not a spectacular grower that's going to double its profits over the next 4 years to stay within the framework of today. So I think it is currently trading at a premium, and it's probably, for all the reasons that I've just mentioned, it's much more reliable, solid, dependable, and that's why it's trading at a premium. It does pay you 5% plus. Claude is correct. And that is expected to grow at a reasonable, moderate pace of the years ahead. So if that is some of the backbone you have in your portfolio, then Aventus could be one of them.
Got it. And it also says that it will pay out. So the payout ratio will be consistent at 90 to 100% of funds from operations. So that's Aventus for Lyle, taken over by Claude. Or I should say Rudi from Claude. Let's get to Kogan for Ben. Saying, could you ask the experts to review Kogan again? I've been watching it for a while, coming down towards support around $10. I know they've got inventory or storage issues, but I'm seeing brokers reporting higher price targets. So what do you think about Kogan, Rudi? We'll start with you for a change.
Yeah, let's start with Rudi this time, because we've had many disagreements today, but I do feel that we are going to be in agreement on this one. The reason why I don't like Kogan, how long do we have?
Not that long.
I'll
Summarize.
keep it very short. Exactly. I'll keep it very short. We've spoken about Kogan in the past. The company gets fined because it actually bamboozles its customers. I've heard some horror stories about their customer support here and there. And I think the two main characters in the business have made it very clear that they want to cash in as much as possible, and they want you to pay for it. It's not on all ESG scales. It scores very low. I do see why brokers get excited about it. At times, it does really well. The question has to be asked whether 2020 was simply an aberration that really fell into their lap and made them perform much better than they otherwise would have. And for all the reasons I just mentioned, I simply will not go anywhere near this company.
Yeah, so I've had a few conversations about the directors offloading their shares. I mean, is that for you, Claude, in and of itself, enough for you to keep away from Kogan.com?
I mean, just director selling isn't enough for me to keep away from a stock generally. But I have to say, the combination, so actually I was mentioning some of that quant work that I've done before in the past. One of the projects that I'm really enthusiastic about is building models that can try to automatically, rate management conviction or rate, use signals from management to understand things about what the share price is likely to do. And I can say with reasonable confidence, I'm not going to get into the black box, but when you have high remuneration, so they get paid a lot, and high director selling, that is a negative. Now, offsetting that, generally high insider ownership is a positive, which arguably you still have with Kogan.com. But overall, in this particular case, the level of in my opinion, high remuneration plus combined with quite regular large sells, or at least large sells from time to time, it's not a good sign. No, that particular factor.
So nothing redeeming about Kogan, considering we're in this massive paradigm shift to e-commerce, online buying. Kogan's moving into everything. I mean, insurance, you know the story. I don't need to tell you.
Yeah.
That's not a... Go ahead.
Well, yeah, I guess there is obviously beyond it, like that's a factor that goes against it. On the other, you know, it has done something well. Like Kogan is a challenger kind of brand that's like come and taken a lot of market share. It again is going to be go in cycles now, probably different cycles than Aventus, but it's obviously just coming off like what was an amazing cycle in favor of Kogan, right? Where you had heaps of extra people using Kogan when they might have usually gone to one of the shops that you know, hires its premises from Aventus, right? So that's been in Kogan's favor, and we're cycling off that now. And yet, at the current market capitalization, it's almost as if Kogan is being priced on 2020 profit, which was like a really good year for them, and the company, and you know, for whatever reason, the market's looking through the really bad 2021 statutory profit. Which the end of the story for me is remains like quite optimistically priced, more so than people think, because I think people are still anchoring to earnings in really favorable environments, and that may change going forward.
Got it. Thanks, guys. Now let's get to Reef Casino Trust, RCT, for Dan. He's wondering if this is a high dividend, low PE stock for the long term, one that could benefit from the reopening trade. Rudi?
Define long term. If it's longer than 2 days, I would say the computer says no. Why? Like, I can only ask why. I mean, this has all the hallmarks of being a value trap, of a dividend trap. Yes, the yield is high, but you have to ask, why is the yield this high? And that's probably the market telling you, you better be careful on this one. If you just look at the past half a dozen years, everything goes down, including the share price. And even the sales numbers go down, the margins go down, the cash flow is not there. I mean, even the volumes, the trading volumes on a daily basis are at times so low that if I would put in some money, I'll probably double the share price. Yeah. Which by no means I want to do, because then I'm caught in a trap where I can't get out. So for me, it's like the big question mark is simply, why would you consider something like this, where you can have other companies that give you an equal dividend yield with much less chances of going into disaster mode?
Got it. Thanks, Rudi. How about you, Claude? Any redeeming qualities in Reef Casino Trust?
No, I'd probably actually argue this is probably one of the worst companies we're talking about today for so many reasons. Everything what Rudi said is true, but the thing is that sometimes you can, and obviously I don't do this, and I disagree with doing this personally, but one thing you can do is you can invest in sin stocks for like dividends and stuff like that, tobacco and casino and stuff like that. But if you're going to do that, and you can kind of get slightly higher returns in those kind of industries because a lot of people shun them, I think like what you want is like maybe probably tobacco, which is even more insidiously addictive and much harder to kick. Casinos, as we've seen, we are literally watching the biggest casino company in Australia get into all sorts of strife, right? I think there's a much more likelihood that Australia, which has huge losses to gambling, right, compared to other countries, we tolerate the absolute taking of money, usually from people who can least afford it, taking their money because they have addiction to gambling. We're giving them drinks and encouraging them to stay late at night and all of that sort of stuff. Australians, we are, if anything, in my view, more likely to come more in line with the rest of the world in recognizing that that's not such a great thing. So I think there's quite a bit of risk in this one for the long term. I reckon you hold this long enough, eventually you're going to get hit by a government that said, we're sick of this. Yeah.
All right, let's move on to Myer. This is for Holly. So Myer is not paying dividends. It is helping, it's turning the business around. So it's got a $51.7 million after-tax profit that it announced yesterday, up from a $13.4 million loss. It will, though, I will say, got a lot of money from the JobKeeper program in that time period. So is this a turnaround story that you would invest in, Rudi?
Computer says no, and I have to ask the question again, why? I mean, a comparison I often make when it comes to Myer is that in the year 1993, their revenues peaked in that particular year, and they have been sliding downwards ever since. And if you just look at the past half a dozen or dozen years, the revenues keep on sliding. So this is basically a story that at some point someone's going to put out the lights. And yes, can it turn around? Maybe. I mean, it doesn't even own its own properties anymore. It already has done everything that could temporarily prop up the profits. Is this company going to have a good year at some stage? Probably. I mean, that's what happens when profits fall deeply enough and the business is in too much strife for the longer term. But again, surely you don't have to be an expert to simply look at this business and really questioning how much life is still in there, and just look at the numbers. I mean, the numbers are going down almost every year. I mean, this used to be a relatively consistent dividend payer, no longer is. The sales are coming down. They have a disaster every 2 years, if not more. At 40 cents a share, I don't know. I mean, I remember it listed at 250, I think, from memory. Yeah. I think the story's been told. Why?
Okay. Why would you, Claude? I'm trying to think of a reason.
No, there's no reason. And honestly, I was going to have a bit of fun laying into it too, but I think Rudi just did it for us anyway. So I might just say nothing further that's like really meaningful to add. For me, this is investing on the wrong side of a long-term tailwind in favor of other kinds of stores. So
there's not value to be found in every name just because it's cheap. Okay, let's get to Polinovo.
Oh, not long-term.
Yeah. Polinovo, Chris, this is for Chris P&V. I'll go to you, Claude, on this one. I think we've talked about Polinovo before a few times. So are you buying that things are reopening, we'll start to see stronger growth in the US and parts of Europe really come through?
Look, I think we probably will see stronger growth. So for filling those viewers in not familiar, these guys have biodegradable medical devices that aid in skin tissue repair, with the main thing being burns at the moment. And look, there's a lot of evidence to suggest they have a great solution. But unfortunately, their revenue growth in the last year was only about 30%, because they say they had a lot of problems selling into hospitals, which is plausible with COVID. But then you got a situation where they're trading on around 40 times revenue or more, and it's only growing at 30%. That's why you're seeing the share prices halved. And for me now, actually, even considering the difficult situation, that growth rate was worryingly low for me, and certainly lower than I would have expected to see. So for me, I would actually I'd want to wait and see revenue growth speed up before getting back on board, because trading at this kind of high multiple, even if it does have a great tech, it does really need to deliver on growth and getting used. It's not enough just to have the best solution. You need to convince all the relevant people that you do.
Yeah, and in FY21, revenue was lower than had been expected. Rudi, but do you buy this on the long-term story?
Well, there's a lot of risk involved, Nadine. I totally agree with Claude. What people underestimate, and this is what makes companies like CSL, Resomed, Cochlear so fantastic, is that they are doing it year in, year out for decades. And to all the credit, I mean, this is actually a life sciences company that actually has a product and they are selling it. So there are sales, and there's a sales team out there, and they're trying to get it into more markets. Now, admittedly, they've probably have been taken a big hit from COVID and lockdowns. Fine. But there's still risks, and the risks are not inconceivable, as we've seen with Appen. I mean, once things start changing in terms of mathematics, share price can go a lot lower. So I would, on a safe basis, I would say, like, it's fine if you know the company, you trust management, and you're willing to take the risk, and their story that it's all COVID driven. That's fine, but still be aware that there's a lot of risk with this company, and they still need to develop this whole business. So at best, I would say, in a general sense, I would say it's a hold while being mindful of the risks.
Got it. Gentlemen, thank you. Now, I did promise our viewers at the start of this, because I will tell tales out of school. Both of you saw the list of these companies and thought that it might have been a bit of a negative program, although I will note I got 2 buys from you, Rudi, with Phineas and Iress, so you don't have to give us a bit of a bonus buy. You can if you'd like. Now's your chance.
Iress.
Iress, that's it. All right, Claude. Claude, I don't want to leave you with the reputation of being a negative Nelly. So, what is floating your boat these days?
Well, actually, one company that I haven't really talked about for a while, and it's been in the doldrums, sort of share price wise, is Volpara. That's a company that does software for breast imaging, and obviously, like, this is super important. When we saw less women having breast cancer checks during the pandemic, we saw more people dying of breast cancer. So it's important to get these screenings. These guys are really all about making those. I really love the mission of this company. Its share price has been pretty much flat-ish now for about 3 years. Just got super excited of taking a while for the company to catch up. Like Polinovo, it said it's had a bit of trouble during the pandemic. If you believe it, like Polinovo, if you believe that, then I reckon either the growth will speed up. But unlike Polinovo, these guys are, I think, more on closer to about 10 or 12 times revenue. So I reckon there's probably a bit of upside there. I'm a long-term holder. I've got some shares now, but I have traded it over the years a little bit, and I'm more in the mindset to try and accumulate now.
Well, lucky you, Claude, if you haven't seen it already. We spoke with Volpara's CEO just this morning. So we've got that interview up online. Yeah, there you go. We did not plan this, people at home.
No.
There is that interview. Good. All right. Cool. Guys, I always like spending a bit of time with you on a Friday. Thank you so much for sharing your insights and your wealth of knowledge and a few laughs as well.
Missing you
Thank
too
you.
already.
So fun as always.
Claud Walker from A Rich Life, Rudi Filapek-Vandyck from FNArena. Have a good weekend, boys. We'll see you soon. Thank you. And I will take you through just a very quick sum up of what we learned there over the past half hour or so. Where am I starting? I'm starting with Aventus. Rudi's a holder. He likes it. He's a happy holder, he says. It's a dividend player. Claude says, look, at best he'd be holding it, but he just doesn't like these cyclical plays. You know that. Kogan, it is a avoid for both of these guys. Rudi really doesn't like Kogan. He says management is cashing in as much as possible and they want you to pay for it. Reef Casino Trust, it's an absolute no from both of the guys. Just no. It's a value trap as well, in Rudi's opinion. Myer, it's a no from both of these guys, and Polinovo as well. Well, Claude wants to see a bit of revenue growth, so it's a hold. It's a fine hold for Rudi, but think it's risk in there as well. But do it all with your own circumstances in mind, of course. That's our show for today, actually, and the week. It's been great to have you join us as well, and thank you for all of your suggestions for our guests. You can send one to the call at ausbiz.com.au, or you can tweet us at ausbiztv. We usually, just as a PS, don't get to them on the day because we do prep for the show, but we always put them on our list. If you'd like to see that portfolio again, you can head to ausbiz.co/portfolio. Now, don't go anywhere, though. You want to know what's been moving on the NAB trade platform this week, and Gemma Dale has all the stats. Also, in the next half hour, we will be learning more about the vaccine passport situation off the back of the National Cabinet meeting this afternoon with ACCI's CEO. Plenty to come. Don't go anywhere.
Currency play here. What are you expecting? Is it a euro trade?
For me, it's using a wider trailing stock and trying to capture those big medium-term trends.
Generally, I like my trades to have a reward to risk of 1.5 or 2 to 1.
The bulk of the money is being traded right now on this sort of research.
The Trade is brought to you by markets.com. The world of financial markets, your way. Make the switch today.
Hey, g'day. It's gone 1 o'clock in Sydney. That means it's time for The Pulse on a Friday afternoon. I'm Andrew Kogan. Great that you can join us. Let's take a look at what is making news today. Aussie shares falling, dragged down by those mining stocks with commodity prices coming off across the board. And tech companies, I think that is actually off that chart at the moment. But the index shedding as much as 4% as iron ore prices, that's obviously in the mining space there, iron ore prices falling by more than 3%. Fortescue Metals leading the materials laggard, hitting a one-year low as brokers UBS downgrade the company to sell and slashes the price target to $15. Gold stocks also low, with Newcrest Mining losing more than 3%, Northern Star off close to 4%. This as bullion prices retreat on dollar strength and fears of a November taper by the US Fed. And Iress shares taking a hit after takeover talks with EQT were pulled off the table. It is the third attempt by EQT to acquire Iress, valuing the company at $3.2 billion. All right, well, let's get a reader on what investors have been doing this week. Gemma Dale joining us from NAB Trade. Gemma, g'day. Good to talk to you on a Friday, as we normally do. Look, I make a joke about this every week, that Fortescue, we cannot do this segment without talking about Fortescue. And I guess today, for very good reason, given where that iron ore price is going, these stocks, these iron ore miners, very much in focus at the moment. Tell us how investors have been playing this week.
Yeah, it's been front and center for our investors for about better part of this year, let's say. So in 2020, Fortescue was not even in our top 10 in terms of total trades. It's quite fascinating how uninteresting it was to the broader base of investors we had. And we had a small number of wealthy investors who'd started accumulating late last year and saw the opportunity. And then it's all I talk about this year. It's been pretty much the only thing, right? It's been driving so much of our volumes. And it has been wealthy investors sitting behind that. It has not been the entire base. It's been a sort of fairly select group of people who really have loved this trade and have been moving pretty actively on it. So it's been quite fascinating. You and I have been talking about it for ages, and we've been waiting to see what will happen when the iron ore price comes off. We all knew it was going to happen. Nobody knew when exactly. UBS said today happened faster than they anticipated, and I think many people feel that way. We knew it was coming, but now it's really coming, and falling in half in a couple of months. That's quite spectacular. What is most interesting to see, it's very high volume still being traded in it, so it's still something that people are moving on. But what we're seeing is our bigger investors are selling, and they are selling in very, very large volumes, and smaller investors are picking up a piece. So for our smaller investors, and this is mums and dads and retail investors and self-managed super funds and so on, they are accumulating something that they felt was too expensive, and now they're going, you know what, it's worth a punt at this price. At the upper level, they're going, it is time for me to move to the sidelines on this, and I may pick it up cheaper later on, but I'm definitely not holding it as the core of my portfolio. So quite interesting to see. And BHP is quite similar, so similar trajectory, even though it's a much more diversified company, obviously, despite the divestment to Woodside. They're getting some selling at the top end and some buying at the lower end, and it's quite a mixed overall volume. So if you have a look at the volumes, they kind of look okay, but if you look at who's doing what, it's quite telling.
So if we stay in the mining space, there is a lot of action across the board, in fact, because particularly lithium, off the back of that auction that Pilbara held a little earlier this week. So lithium, I guess more generally battery metals, very much in play at the moment.
Yeah, it's not a new story, obviously, and it's been somewhat volatile over a decade now, and everyone knew this one was coming too. We know that there is going to be this transition, the energy transition, and lithium is absolutely a core part of that, and we happen to have extraordinary deposits in Australia, which is fantastic, and so we have an opportunity to do very well out of this, and a lot of our investors have been looking to play this for a while. Pilbara Minerals is the favoured stock for them, but they've also had Orocobre and various others. What is really fascinating about this at the moment. So the price is going in the opposite direction to what's happening with iron ore. Iron ore is collapsing, lithium's going through the roof. And as you say, they had that auction, they had one in June, and the price is now dramatically higher. What are we talking, 4 months later, 5 months? Dramatically higher prices. And we are seeing large sales, and we're seeing small buys. So our smaller investors are trying to get a piece of this for the first time. A lot of our bigger investors have been holding lithium plays for a while, and they're going, I'm going to take some profits on this. This is quite nice. They're also moving out of iron ore. What's most interesting is I don't know where they're going. So we haven't seen any telling buys from our larger investors who've been holding this stuff. They'll have to start picking up something soon.
Yeah, I thought maybe Telstra, maybe a buy, but talk us through what's going on there, because they had a very positive update a couple of days ago, and just looking at some of the broker moves, and also analysts we're speaking to saying it's looking really impressive. So what have investors on your platform been doing?
Yeah, clearly our guys, whether they feel it's impressive or not, they have been waiting for an opportunity to sell. Telstra's very, very widely held in the base, and it's been widely held for a really, really long time. It's obviously one of those stocks that many retail investors picked up in a float. They held installments back in the day. This is not something that's new to their portfolios, and a lot of them have been just waiting for an opportunity to sell. They've clearly been waiting for a number. So we have alerts obviously on the platform, as you would hope, and the alert was clearly $4 because our average sell price yesterday was $4.00. That was exactly where everyone got out. 80% sell across the board. Everyone was waiting for that number. It's off again today. So clearly that $4 mark was exactly what people had been hoping for. And a lot of them had been hoping for it for a really long time. They're not willing to wait and see whether Telstra can actually.
Oh, unfortunately, I think we've lost Gemma there. We'll see if we can reconnect, but obviously just talking us through what's popular, what's not on the NabTrade platform. And as that's concerned, particularly obviously the miners coming off a lot of trade in Fortescue, as she mentioned there. But also Telstra, interesting that it is a sell for most. Gemma, I think we've got you back there. So yeah, just sorry, pick it up.
The other one that's really interesting is